Hello, everyone. Sorry for the delay. I just got off a flight, so it was a bit of a last-minute rush, but excited to be here and to talk a little bit about economic risks with a bunch of different people who have different views on it. So maybe first, to get started with our panelists, maybe we'll go one by one and have you introduce yourself with sort of what your name is, what you're working on, and what your sort of favorite incident was that was a big learning lesson for you in the way you think about economic risks in DeFi.
I can start, yeah. My name's Alex, and I work with Gitcoin and with DAOs generally for Web3 native risk. So kind of a big topic for all the Web3 native things that can go wrong these days. But previously I was an analyst at Coinbase. And my favorite exploit of the moment, the thing that's on my mind a lot, and I may talk about this a little later because it's been a bit of an obsession point, is governance attacks, is where we see sort of new avenues of DAOs that are doing self-governance and doing interesting things with their funding mechanisms actually being attacked and folks coming in either through social engineering of the DAO or through like an outright token manipulation. And those have been top of mind for me.
Hello, everyone. My name is Marijo Radman. I'm the co-founder of Solity network. We are building a risk infrastructure for decentralized finance, more or less indexing the DeFi ecosystem and in real time assessing the risks, including economic side of the risk. I will say like my favorite economic risk would be Terra Luna, because this was actually the time when we were in a funding phase. It happened at the right time that we managed to close the round. One I really liked was a unique one. It was the Binance chain stop or halt by CZ. I really liked what happened then when all these liquidation events started to happen on those smaller yield aggregators and so on, lending protocols. It was quite funny to see what can happen in DeFi when a chain gets stuck.
Yeah, thank you. I'm Yaron. I'm the founder of B Protocol. B Protocol historically was a lot about on-chain risk mitigation solutions, mostly for lending markets. Recently, we also started to work about on-chain economic risk optimization and lending market parameters. I'm also a contributor to the Risk DAO, who is also kind of giving it as a service. And yeah, my favorite incident, maybe other than the classical Luna and other ones, so we focused mostly about lending market and stablecoin risks. So there was a bit of a niche attack, but overall resulted with over $200 million of loss. It was back in the maybe end of the DeFi summer days. There was a platform called Rari Capital. It had the lending market that was actually governed by Ichi. There was this thing called Ichi. The short story there is that probably intentionally, but maybe just negligence, set up very loan-to-value ratio for their own native token, which is, as expected, sort of served as an exit liquidity for token holders. Token obviously pumped, like 100x or so. Yeah, until certain point it stopped pumping, and people lost their tens of millions in actual money, USDC, DAI, etc. And it demonstrated very well, both the need for risk management, but also kind of all the pitfalls of all the compound forks, but lending markets in general, and how to recover from an attack, how to actually act when an attack happens, etc. So yeah, a lot of kind of lesson learned from there.
Hey everyone, my name is Primoz. I'm founder of Block Analitica. We do risk proposals for MakerDAO, but we also build risk dashboards, customized risk dashboards, and recently we also launched one side project where we try to score borrowers in DeFi. My best example of economic risks, probably because I'm more on the financial risk side, is the attack of, it actually happened on Solana, so the Mango Markets attack, later known by attacker known Avi. Why it was interesting for me, because the code worked as intended, like he just manipulated the price with perpetual futures, pumped the price 30x, used collateral to borrow, I think, over 100 million of other assets. And yeah, it clearly shows the protocol was misconfigured. I'm not even sure because it's on Solana, but I'm pretty sure it probably didn't have any borrow caps, supply caps, or any of those. And yeah, this clearly shows that active management, even if the protocol needs to have parameter configuration for this kind of stuff. And in this case, even if it had it, like it was improperly configured.
Cool. So, we covered, I guess, a breadth of different types of attacks, whether it's governance attacks, Oracle attacks like the Mango case, or sort of bad mechanism like Rari, in the sense that there was no sort of adjustment that could be made. But I think maybe broadly speaking, I think the term economic risk is probably highly overloaded and has continued to become more overloaded over time as people try to bucket particular technical risks into economic risks so that auditors can say that's not their job, or vice versa. People on the economic risk side say, hey, this is a auditor's problem. So I think a good kind of coming to consensus on vocabulary, it would be good to kind of hear from each of you about how you would define economic risks and what you view as sort of the boundaries of things that count as economic risk versus not. Now, obviously, it's a fuzzy line, and that line changes over time, but just like, what is your sort of best unbiased estimate of the definition of economic risk?
Yeah, firstly, I really appreciate the question to kind of push us in our definitions as a community, but I wouldn't necessarily want to define DeFi economic risk as distinctive of what we think about with CeFi economic risk, but I think there's sort of a difference in scale because you are operating, as for the first time in a financial system where each person is assuming complete culpability and autonomy in their environment. So I think you have kind of like a movement from the micro risk that can then be understood at a macro scale, and whereas when we study economic risk in more centrally arbitrated areas, you're going to see sort of macro influences moving to the micro scale of what an individual person or an individual company might experience. So I guess I would add that little distinguisher of just sort of starting with first principles when we think about DeFi specific risk, and offer that as perhaps an addendum to the traditional definition. And I do appreciate also teasing apart like a technical contract. Is it broken? Is it malicious? Is there a backdoor for this chain? Those types of pieces, I think, can fit into the wider economic risk to understand the sector without having to be completely conflated, right? Sort of take it as the wider trends and the fact that complete self-custody and these new mechanisms we have for exchange, that perfect autonomy is what's creating the risk surface area in general.
I believe it's working, right? I believe it's a very interesting question. I mean, when you look at the technical risks, you can always see these are the trigger points often in the economic sphere of risk, what happened afterwards. I distinguish usually like at Solity in two parts. You have the first one is more of the protocol design level, where you basically want to optimize your protocol that it behaves in a stable manner. And the second one is more of a liquidity provision, where the whole liquidity is actually interconnected and there are consequences when some kind of triggering mechanism happening. And now the question is like, okay, we are now in this gray zone because there are many trigger elements, and how far are you going there? And that's basically where we say, okay, let's take in the economic risk sphere everything which is there, which is not from the traditional finance space there, like all this stuff, what they are doing, like sharp ratios and so on, cut it there. Let's not go in the hardcore security audit side, and everything in between is actually economic risk, because DeFi is a composite and you have to deal with it. on a large scale.
Yeah, so my view is that economic risk is basically what will happen to you kind of on a bad day, what will happen to your platform on a bad day. Where kind of more classical cybersecurity is, what will happen kind of in the presence of a malicious actor or an attacker. And of course, it's not mutually excluded. You could have so-called financial attacks. But there also, I think, there is sort of a clear border where eventually economic risk is something you could take, as opposed to a lot of classical security risks, which is, like a clear sort of, no-go. In particular, even if you take, take Luna as an example, in my opinion, even listing Luna or UST in some, in your favorite lending market, so it is a risk, but economic risk comes with a reward. No matter what the parameter is, it could be under certain scenarios a reasonable decision to do, one thing or another, as opposed to the more classical risk, which is, sort of down only, and you should never go there. So.
Yeah, for me, economic risk, it's a subset of technical risk impacts economic risk, but economic risk can also arise from governance risk or oracle risk or any kind of risks, really. What I most closely associate it with is basically misconfiguration of parameters at a particular lending platform, or even the design of the lending platform not being properly configured, designed, basically. The best case is probably Aave V2, where it doesn't have borrow caps, right? And we saw how this can go wrong in some ways. If it has these parameters to limit debt ceilings on certain assets being borrowable or limit supply caps on asset used as collateral, then it's always about configuring it properly related to the token liquidity, token volatility. What we also do in our risk models is we look at the borrowers, how they behave. For instance, if we see the borrowers are managing their wallets actively, they react when there's a market crash, we know the loan book is safer, right? So it's all these attributes that kind of affect the risk premium we calculate for any lending platform.
Yeah, I think it's interesting that the first two answers were very sort of like broad definitions, and the latter two answers are sort of extremely in the weeds on one particular subset, which in and of itself gives you this question of like, are there actually really good ways of formally describing economic risk? I would sort of have a different definition than probably everyone here, in that my definition would be something akin to, you have some notion of the utilities or payoffs of individual users and user types. You have the notion of the joint payoff of the entire system. And you want to look at where the maximum deviation between the max joint payoff and the sort of expected individual micro payoffs differs, because that sort of controls at some level the highest risk in your system. And this is something that's sort of becoming more generic as these risks start to expand in scope. And one of the places where we've seen risks, especially economic risks, expand a lot in scope is in cross-chain assets. So, of course, bridges have historically been the main source of cross-chain assets leading to security vulnerabilities. Of course, as we all learned over the last week, multi-party computation can really mean single-party computation, as multi-chain proved. So, fast forwarding, if we take a forward-looking view on this, where do you see economic risks diffusing over time, especially in the cross-chain world, where these risks are less atomic, and some of the guarantees you have, even from things like debt caps, may not actually be taking into account some of the remote chain behaviors? And what do you think mitigations for those are?
Yeah, coming from a data background, like to get a little bit in the weeds on this one, but I think it's really important to realize that sometimes we're mapping traditional finance modeling, and I mean we, the data community, is guilty of mapping traditional finance mechanisms onto our DeFi mechanisms as if that's going to be like a one-to-one. And so we're using a lot of traditional methods to both project over time, to do our risk models. If you have automated systems that are doing any kind of risk detection or anomaly detection, a lot of these things are not necessarily utilizing Web3 subject matter expertise to the extent that they should, in my experience. So I think really it becomes, to say like where it's going to diffuse over time and sort of guess at where this is going to go, I think the subject matter expertise and being closer to understanding, sort of even at a community level, what the different chains represent, what they're used for, how those communities may behave distinctively and present different risk surface area. We could, do a quick projection model and just use mainnet, just take everything into ETH before the data gets ingested. And oftentimes that is what analysts are going to do. But you could also represent each chain as a signal. And we understand that layer 2s also as a signal. Is someone utilizing layer 2s? Which layer 2s are they going between? Sometimes that could be an anonymity preserving mechanism. As we start to sort of dig into these models, you can add nuance to it when you understand and respect the difference in the way that these financial systems function, and we're not just sort of slamming them through the models that work really well for centralized finance. So I sort of see a continued blossoming and nuance with multi-chains, more layer 2s on the horizon, more use cases and interesting communities popping up there around these different things. And I see that being the onus then on data scientists and analysts to take those signals seriously and understand that any of those could help be not necessarily a fully independent signal, but one that's in close relationship with your more traditional risk signals.
I mean, I agree with you, like, probably the only way to deal with those kind of risks, especially in the future, is going to be like big data approaches, because DeFi is a 24/7 business, and only way to automatically be able to assess what's happening is a real-time assessment through big data approaches. Now the question is like, how far are you going there? Because the main problem, like when you go in this direction, and we at Solity are going in this direction, you realize like there are so many of those trigger points, so much deepness you can reach, and the complexity gets so high. The question is like, what is the meaningfulness out of it? And I guess there is no way around besides these preventive security-related solutions which are there when they see something's happening that they stop. I believe the best way or the safest way is going to be once we reach a point where we index or whatever the whole ecosystem, we have most of the liquidity captured, and we understand the interconnectedness there, that we can kind of build risk models, what could happen. Like, because the problem is now DeFi is small, constantly new protocols are arriving, they are getting from zero to like almost billions in liquidity very fast. It's kind of hard to integrate those protocols, make it like get a holistic overview of what's happening. But with time, DeFi will get more stable, more liquidity will be there. I guess most of the liquidity will be like with top 50, top 100 protocols. And then all these big data approaches will make a lot of sense. You will be able to capture the equilibrium of stability, I would say, like in the space. Yeah.
Yeah. So other than potential bridge hacks and getting wrecked, which is really like a hard problem and also very hard to analyze and also to predict, we also see some other phenomena, and there are actually things to do. It used to be very common, like for a new L1 to come and just for compound and Aave, and then list like completely standard assets such as ETH, Bitcoin, some kind of stable coin, and then come and say, okay, we have exactly the same assets as compound and Aave on mainnet, so let's set the same risk parameters, etc. So I think even at that level, and this is something that projects can actually operate there. So understanding that even in the financial setup, the liquidity is very different on all chains. Liquidations, especially big liquidations, might take a much longer time to execute because the liquidity is fragmented and sparse around and mostly on mainnet. And these are things that can be modeled, and we do model, but it's also important to have some awareness there. Also, it's mostly best practice, kind of on a technical level. If you set up a new lending market on a different chain, so more often than none, so okay, you kind of neg Chainlink a lot, and eventually they do deploy some Oracle there, but very often the oracles actually quote not what you think they quote the price on mainnet, not the price on your chain. And then, okay, so people maybe enjoy kind of mocking, these lending markets after they get hacked, but there's no really a way around it, typically they are forced to do it, but there could be, some monitoring steps there that could, act in some near real-time manner at least to mitigate this. So I would say, like Oracle integrity, DEX liquidity, these are the things that maybe you could handle as a cross-chain protocol. And then for bridges, mostly pray that the bridge won't get hacked.
Yeah, at Maker, we have this incredible hard task right now to actually quantify, to calculate risk premium of certain exposure to different L2s through certain bridges. And if you think about it, like that's incredibly hard. Like these are low probability, high impact events, right? It's like, I don't know, insuring a house against earthquake, but we have like 3 years of data. And yeah, it's going to be really hard. Luckily, we have L2 bits supporting us, who are probably the best in space with the risk framework. So there is a benchmarking approach to it where we could actually identify the risk scale of certain bridges and L2s. But again, yeah, coming up with a final number we actually need for this new reformed Maker system where allocator DAOs will be charged to deploy capital, it's not going to be easy for sure.
Yeah, I think Yaron's point about Oracle integrity across chains is probably one of the biggest things that we've seen as a source of loss on some of the third sort of like lower liquidity chains. But I think it's not even necessarily just strictly the bridge risk as much as there's also people starting to do slightly new mechanisms that interact with consensus more or like take advantage of particular sequencer guarantees which don't exist elsewhere, and then they don't realize they redeployed a forked contract that makes particular assumptions about the ordering behavior on mainnet versus the ordering behavior on a particular L2. And those types of things have started to really been sort of blossoming over time. I think we saw the first ever real consensus instability causing huge DeFi loss attack in April of this year when a malicious ETH2 proposer was able to get the contents of a block before, sandwich everyone, and then kind of cause some kind of long-scale attacks. Now, this is probably the most sophisticated attack we've ever seen so far in terms of the amount of sophistication of someone having to run a validator, having to probabilistically know roughly what time they would be chosen as a proposer, then based on being chosen as a proposer, injecting a bunch of fake transactions and fake blocks at the right time to cause a fork to lead to a big loss. So, as these types of things start to become much more plausible and doable in a fragmented L2 world, how do you think about these interactions between DeFi and MEV and how that's going to change protocol design over the next cycle?
Yeah, so MEV is actually a really great example of when, because there was this economic incentive, the community really hurried up and built some products that are extremely sophisticated. They operate in real time. The amount of scanning that they're doing with available chains is super impressive, and the development of that over the last 2 years is pretty incredible. So I think we need to do something like that for anomaly detection as a community. And this does get a little bit more gray because this turns more into the realm of sort of the whole community taking mutual responsibility and also those best practices being shared in an accelerated, rapid way. So I think I really like that Marijo brought up like the need for indexing and indexers as data products, like almost as a public good, making this like clean data available, making contracts transparent, commenting things out in reasonable ways that sort of allow that increased level of transparency. These kinds of like layer 0 level practices and sort of like layer 0 level cultural tenets that the DeFi community can continue to cultivate or maybe begin to cultivate in many cases will create the more secure systems that we need, because then you do have data scientists and individual auditing groups all the way to the level of the protocol being able to develop sophisticated near real-time, if not real-time, monitoring for anomaly detection. And at that point, when you've described what your expected behavior is in your system, then you can imagine that even being moved to the contract level. If we understand the expected behavior when the expected behavior is triggering some kind of alarm bells, we could, over time, begin to move that even to the way that the chain itself is deployed or other mechanisms not yet really experimented with. So I think it, again, sort of data nerd answer, but I see a lot of this coming down to how are we going to think about the community's responsibility and expectations to sort of front run the exploits that are continuing to manifest, and even the breakage that's not necessarily coming from a malicious place, but the breakage that can potentially happen when we're in such a highly experimental realm.
I personally believe it's a really tricky topic. The problem is, like, when we're talking about MEV, it's a very short-term event, to say it like in this way. And the problem is, like, I talked with many of those MEV strategists who are running around, and I learned from them they are now building MEV strategies for MEV strategies. So basically, they are trying to trick MEV guys who are doing MEV strategies. And then the question is, okay, if everything is happening like instantly, like you are fighting on the mempool side, how are you able to react immediately on that side? I mean, we are not anymore talking here on that you have few blocks that you can react or something like that. You have to be able to immediately detect and do something around that. And the question is, like, are you able to detect and then what to do? Like, how are you able to do that instantly? First question. I believe, like, probably from the protocol design, I mean, there are solutions who are trying to make the mempool private and so on, who are going to change a little bit the protocol, could be the way forward, but I'm not sure this is going to be mainstream. So I have a kind of pessimistic view on that side.
Yeah, so I personally think that MEV, might just become another tax on blockchain. But I think definitely, I don't know, maybe eigenlayer and risk-taking solution maybe could impose so-called some sort of consensus attack driven by external incentives. I think in general the problem of having something which is incentive compatible and relying only on economic incentives is pretty long-standing open questions. In my view, even Bitcoin is not necessarily immune, from this stuff. Bitcoin is only sort of proven to, act correctly when you have honest majority, not when you have potentially like a rational or incentive-driven majority. And okay, this is kind of debatable, but it's at least one approach. On a technical level, I don't know, maybe some ZK magic could solve that. If you will be able to somehow successfully separate the execution layer from the way you build blocks and reach consensus. But yeah, I don't know much about it.
Yeah, I'm certainly not an MEV expert, and these things are going to happen. The most boring answer would be that it makes the space more robust. I know the fix was deployed in this case, but I also think, mailbots get a lesson, it's okay at some point, sometimes. But I'm more curious, what's your take, Tarun, because I know this is your area of expertise.
I think it's actually interesting because these types of attacks people have been talking about them for almost 5 or 6 years. Like the first feather forking paper, I think was like Andrew Miller wrote in 2014. The first sort of like time bandit kind of analysis of like was probably 2017 or 2018. So people had talked about this, but there was never any real incentive for the validators to ever do it because it's quite technically risky. Like you could get slashed for more than what you're trying to earn. You also have to do a lot of timing attacks of like ensuring that your position in the network is sufficient that when you're competing with another proposed block that yours is able to reach the network efficiently. But I do think the interesting thing about layer 2s is that having single sequencers makes this a lot easier to do these types of attacks. So from my perspective, the fact that someone was able to execute on mainnet, now of course there's a fix, and you can argue that, oh, like the relays should not have been able to send invalid blocks to the whole network. But that's sort of more a problem of like the design was sort of had some centralization feature, and that feature was exploited. And now it was sort of made harder to exploit it, but it's actually not still impossible to do the same attack right now. So that's sort of, there's sort of this interesting surface area. And I think in L2s, this is going to be a much bigger deal because there's really only one sequencer in a lot of places. And, you know, of course, right now the sequencer is your wink, wink, nudge, nudge best friend. Like, good guy won't do anything wrong, right? But obviously that's not going to last. And I'm sure there's going to be a malicious L2 sequencer. That I think the L2s are going to have way more of these issues than we give them credit for. So that maybe that was my bully pulpit on that. But another kind of thing that's kind of become really interesting in this vein is that some of these technical risks of how contract execution works and how people have implemented particular mechanisms affect economic risk. Now, the Oracle case is the simplest one, right? Of like where you inject Oracle data, how you use Oracle data, how stale the Oracle data is, et cetera, or how synchronized it is to your environment. But we've also started to see a lot of other technical changes to markets impact their efficiency versus risk trade-off. And I think, for instance, examples of this are people working on Oracle-free style lending protocols or risk protocols. So I was curious from your perspective, which kind of technical changes have people been making that have, in your mind, been better for both risk management and risk control, and or have been worse? It could be, you know, it go both ways. And of course, the simplest example is, of course, the Oracles, but I think maybe we can start at Primoz, because I know you've spent some time on the Oracle-free part of the world.
Yeah, I mean, I can start with Maker. There are 2, maybe 3 features. So one thing that's kind of interesting to me, and maybe only Maker has, I'm not sure, is this concept of rate limiter on the debt ceiling part, right? So even though the debt ceiling is really high, you allow just a certain increase in time, right? Of course, this imposes 2 new parameters, some governance overhead. It could also curtail growth, right? Because it happened during a bull market when institutions were minting like crazy, and the debt ceiling was kept for 12 hours and they couldn't mint more, even though we would allow a higher exposure, but there's this rate limiter for a reason, because if there would be an exploit, it actually protects you, right? Another one are circuit breakers for auctions, right? You could make a circuit breaker, and there is one at Maker where, again, you need to specify parameter when you say at certain price drop for certain collateral, let's say you define it at 70%, you say for certain token, you say, yeah, it's more likely the oracles are manipulated than the market's actually falling, and to stop auctions in such case, right? So there's this parameter that's also there. But yeah, regarding oracles, again, Maker is quite specific because it has this 1 hour delay. Because of this delay, oracles are safer. I mean, technical risks are lower because oracles can be actually frozen during that hour. But then you start making trade-offs, right? Because Oracle is delayed, auctions need to be different. So there are Dutch auctions. The Dutch auctions are slower. Because the auctions are slower, there's a bigger market risk. Because there's bigger market risk, we needed to compensate it with slightly higher liquidation ratios, right? So if you look at Maker versus Aave Compound, it has slightly higher liquidation ratio for that particular reason. And yeah, you could even say this again curtails your competitiveness, right? So you always keep making these trade-offs. Last thing I'll mention regarding Oracle's, yeah, there are now new designs. Oracle's Oracle-class lending market, such as Ajna, that was launched, I think, yesterday. And yeah, I looked into the design. It's you know, because there's no oracles, it gets really complex on the auction side, right? There's a whole new complex mechanism of how you kick auction, how system penalizes somebody who kicks auctions, but it shouldn't because the market price is still okay. I mean, the LTV ratio is still fine. So you start making trade-offs, basically. That's the TLDR.
Yeah, so I think kind of historically, a lot of the lending best practices sort of started from Compound, you know, back in the early 2019 or 2020. You know, most of Aave first features were also following Compound. And I think, yeah, like one nice trend is that we kind of see even Compound itself, you know, kind of evolving and kind of self-learning and trying to change parameters there. So obviously, you know, even Compound started without any borrow caps and supply caps. Now it's becoming, you know, sort of best practice, and it's much easier to run risk management such way. Compound V3 is also going to the direction of mostly segregated markets where you have one debt asset and maybe one collateral or multiple collateral, but still segregated. I think liquidity sort of solved the problem. There was a huge, you know, kind of gap or even bug about not socializing bad debt. So I think liquidity were the first one to do it. Maybe I will end with, you know, maybe a more concerning trends. I think there's sort of a trend now trying to improve the liquidation mechanism towards, you know, sort of auction or variable fees in order to save MEV. I think, for example, this has also downsides. Okay, so the evolution is not only making it easier, but also sometimes have downsides.
I know we just got our 1 minute, so I want to give everyone one last concluding thought. So what thing are you most excited about in that related to economic risk that's either going online or just came out in the last, you know, for the next year? Like, what are you looking forward to?
Over the coming year, I believe what's going to be interesting is to see like these risk solutions that are coming like more and more in the space. More competition is there. And that will lead also to more stability in the space. And hopefully also when we look at the middleware innovation side, we will end up in a situation to have something like data-driven smart contracts. They are going to be smarter, more adaptive, and this is like exciting to see. Like, it's a huge risk, of course, or it's a double-sided sword, but it could also help on many topics we have at the moment.
Yeah, to keep it succinct, I'm most excited by Web3 sort of being able to make good use of some recent gains in distributed computing. And this is everything from like consensus layer attack strengthening, like perhaps we get used to seeing what the minimum viable number of nodes is and what the mathematic principle is that describes the strength of a chain before we even like inform adoption or inform that rollout. I don't personally think, I don't want to misspeak here, but I don't think any of the layer 2s are even close to meeting those needs right now, just from a technical specifications point. So I'm excited for Web3 to kind of be in mutual dialogue at a few different levels, like synthetic data, AI guided has been really prominent in Web 2 progressively more, and we could do that with, you know, synthetic on-chain data to sort of begin to test principles, stress test them, and see them in practice in a more pragmatic and grounded way than let's ship it and hope for the best.
Yeah, so I'm most excited about and naturally work a lot about is trying to sort of replace a lot of the risk mitigation logic and replace risk managers and DAO decisions by smart contracts. And I'm also giving a talk about it in the evening session. So yeah, come hear it out.
I'm mostly probably excited about these permissionless pools for lending, such as the Sajna case. Not necessarily Oracle style, but just like Uniswap style lending, right? Where I think Fuse was close to it, right? Where anybody can deploy pools, and different LTV ratios, right? So we have full flexibility, and you know, the most capital efficient markets actually would come from these kind of new primitives.
Cool. Well, thanks everyone for your thoughts, and give a round of applause for our panel.